Gold's done its job. People have asked me for years, when's gold going to move? And I say, 2000. Price of gold in 2000 was $253, $254 an ounce. And it moved up to sort of $1,900 an ounce. So that's what, 8.6, 8.7% compounded for 22 years. If you're asking for a commodity that as a savings instrument could shield you against inflation, if you look at when gold was going to move at the beginning of the century, it did move. The move has accelerated and it has excited people. To me, the move that we've seen so far is a non-event, really. I think it's a flow of funds issue. I don't own gold because I think it might go to 2,400 or 2,200 or whatever the number is. I own it because I'm afraid of the possibility, not the probability, but the possibility that it goes to $7,000 or $8,000 or $9,000. That's not very far-fetched.
Rick Rule's take on gold is quite intriguing. Reflecting on its performance since 2000, he highlights its impressive growth from $253 to approximately $1,900 per ounce over 22 years, showcasing an astonishing 888.7% increase. To him, gold isn't just a metal. It's a reliable shield against inflation, serving as a key component of any diversified investment strategy. Interestingly, while some might see recent fluctuations in gold prices as insignificant, Rule views them through a different lens, attributing them to the ebb and flow of market funds rather than any fundamental shift. His investment philosophy regarding gold isn't fixated on arbitrary price targets like $2,400 or $7,000. Rather, it's rooted in the prudence of guarding against extreme scenarios, such as the potential for gold to reach heights like $99. Furthermore, Rule's analysis of recent price strength in gold unveils a deeper narrative. He suggests that it's not merely driven by retail investors' concerns about purchasing power or traditional market dynamics. Instead, he points to geopolitical factors, particularly actions taken by the U.S. government regarding Russian holdings of U.S. Treasury securities and the weaponization of the SWIFT banking system. These actions have reverberated across global markets, shaping the trajectory of gold prices in unexpected ways. Overall, Rule's insights offer a nuanced perspective on gold's role in investment portfolios, emphasizing its resilience amidst economic uncertainties and geopolitical tensions.
But when the SWIFT banking system began to be weaponized to further the political interests of the United States government overseas, other central banks felt themselves left with no choice other than to look for a store of value and a medium of exchange that was outside of the control of the U.S. government. The easiest place to go was gold. Many people say, well, why don't they just trade with each other in their own currencies? There's an easy answer to that. As little as they trust us, they trust each other less. The U.S. dollar, laughingly, is the worst currency in the world, with the sole exception of every other currency. The Chinese don't want 1 trillion rubles. And what that means is that in order for Iran to trade with China, China to trade with Russia, Russia to trade with Brazil, they need a medium of exchange outside the US dollar. And the strength that you have seen in gold has been almost entirely foreign central banks buying gold because they don't have any other alternatives. If you lay on top of that the realization on the part of investors that their own purchasing power is degraded by holding fiat currencies, I think you could see sharply higher gold prices. Here's another statistic to support that, James. According to JP Chase, the market share of precious metals and precious metals related assets in the United States is about 0.5% of the total value of savings and investment assets in the United States. For reference, the United States has a 23% market share of world savings and investment assets. JP Chase suggests that the 4-decade mean market share of precious metals related securities is 2%. So if precious metals merely reverted to mean, demand for precious metals and precious metals related assets would quadruple in the largest savings and investment market in the world. And that's precisely what I think is going to happen. Just a reversion to mean. Just a reversion to mean quadruples demand. Remember that prices are set on the margin, not across the totality of the market. And I think that that could, not next week, not the week after, maybe not this year, maybe not next year. I think if you think in 5-year terms, 6-year terms, 7-year terms, and you think about the continued politicization of the US dollar, if you think about the deterioration of the purchasing power of US dollars, particularly given low interest rates relative to the deterioration of the purchasing power of the dollar, and then you think about the infinitesimal market share enjoyed by precious metals, those three factors come together, and I think they give you a picture of what I actually believe is likely to occur in precious metals markets, which is to say not only higher, but sharply higher.
Rick Rule's insights into the dynamics of gold's surge offer a thought-provoking perspective. He delves into the pivotal period from 2002 to 2006, attributing gold's momentum to a combination of factors such as shifting perceptions of global stability, declining interest rates, and a weakening US dollar. Rule also acknowledges the role of selective inflation in raw materials, driven in part by technological advancements and robust demand, particularly from China. Despite these observations, Rule remains cautious about drawing definitive conclusions, recognizing the intricate nature of market dynamics and the limitations of interpretation. His nuanced approach underscores the complexity of gold's trajectory and the challenges of pinpointing causation amidst multifaceted influences. Moreover, Rule sheds light on recent market sentiment among retail investors, revealing a fascinating divergence between market perception and underlying sentiment. Despite gold's ascent to nominal highs, retail interest, as gauged by physical gold ETFs, has remained bearish until a mere 12 days ago. This revelation underscores the complexities of investor behavior and the dynamic interplay between market sentiment and underlying fundamentals.
I think that changes. I really, truly think it changes. If you consider the biggest enemy of gold to be the U.S. 10-year Treasury, the ultimate fiat instrument, let's think about the arithmetic around the U.S. 10-year Treasury. The U.S. government promises to pay, and they will, even if they have to print, you 4.2 or 4.3% per year on your savings in a currency where the depreciation of the purchasing power is 7%, which means that the U.S. government in actuality is promising to make you poorer by 2.5% a year compounded for 10 years. I think they'll keep that promise, but it's not a very attractive one. So I would suggest to you that ultimately in the psyche of investors, gold's competition is an instrument which promises to make you 2.5% a year poorer for 10 years. I think gold can stand up to that fight.